Thanks, Alex. It's a great pleasure to be back with everybody today. I want to talk to you today about using MaxiFi Planner to make investment and spending decisions. So and I do want to ask you if you would to maybe hold off running the program until after the webinar, because if we have up to 2,000 people running it at once, we don't want to crash Google, which could possibly happen, but just hold off on that until after the webinar if you could. So the agenda is going to talk about kind of the background of economics and financial economics and finance. So we're going to talk about what economics brings to the table when it comes to financial decisions, and I'm talking here about investment decisions primarily. Going to talk about how consumption connects to your living standard. We're going to talk about how you assess living standard risk. I'm going to show you how MaxiFi does all that, how it assesses living standard risk, and it uses Monte Carlo living standard trajectories, and I'll explain exactly what that is. And I'll talk to you about how diversification can limit your living standard risk, and also how aggressively you spend through time, or how cautiously you spend, how you spend through time can affect your living standard risk as well. So your living standard risk is really a combination of two things: how aggressively you invest, but also how aggressively you spend. And then we're going to talk about something that may be new to most people, probably is new, but it's an old hat to economists, which is ultimately coming up with a portfolio investment strategy and a spending strategy that makes you, on average, as happy as possible. That's what economists call maximizing your expected lifetime happiness, or we call it utility. So I'll tell you all about that. I'm also going to go through a case study that illustrates what I've been talking about that we've set up in MaxiFi. So here we go. Let me just briefly say that economics has a life cycle theory of saving and consumption and investment and insurance, and it's a century old. It really started with work by Irving Fisher in the 1920s, a very famous Yale economist. All modern finance is based on the life cycle theory. It has this key prediction, which is consumption smoothing. And the idea here of consumption smoothing is that you want to have a stable living standard. And what that means is that you want to be able to basically have the same living standard through time, but also you want to have the same living standard across times, across good times and bad times. So just to kind of very briefly reflect on the history of economic financial thought, the life cycle model, as I mentioned, was initially developed by Irving Fisher in the 1920s, but over time they introduced the Nobel Prize in economics, and it's garnered perhaps, depending on how you count, 12 or 15 prizes in economics that are in large part related to finance. So Franco Modigliani might be a name that some people have heard. He won the Nobel Prize in economics for working directly on the life cycle model to explain saving and growth. And we have these major names in finance: Bill Sharpe, Harry Markowitz, Jim Tobin. They all work directly on the capital asset pricing model. Each of them won the Nobel Prize in economics. They all used this utility maximization framework I'm going to tell you about. There's a very famous economist in Israel named Menachem Yari who did fundamental work on understanding the economics of life insurance and annuity insurance, and showed that they're really opposite sides of the same coin. He hasn't won the Nobel Prize yet, but I'm hoping he will. But he's also using the life cycle model. It's fundamental to his research and findings. Bob Merton is arguably the Isaac Newton of finance of all time, and he worked on option pricing and won the Nobel Prize together with Myron Scholes. But his fundamental book on continuous time finance is grounded in the life cycle theory. So I'm just trying to get across the idea that this economics that MaxiFi embeds, which is the life cycle model, has a long tradition in economics. So we've got other people like Milton Friedman, who may be more of a household name to many of you, who won the Nobel Prize for work in part on his permanent income hypothesis, which is just a variant of the life cycle model. So with that little short history, let me just recall what consumption smoothing, and I've mentioned this last couple webinars, is about. It's just, it goes back to being satiated. If you're sitting down and having some dessert and somebody puts a big plate of cupcakes in front of you and you haven't had anything to eat for a few hours, that first cupcake is going to taste really great. But after you've had 20 or 19 cupcakes, the 20th cupcake isn't going to taste so great. And that's satiation. And consumption smoothing is rooted in physiology. That's what we have. That's what we mean by. I think I misspelled rooted. It should be R-O-O-T-E-D. Anyway, it's rooted in physiology, and that's the proposition that we get satiated, we get filled up. So your satiation can either come on really quickly or come on slowly, depending on who you are and your physiology. Now, economists call the satiation speed your degree of risk aversion. How fast you get satiated, we call your degree of risk aversion. So with a very high risk aversion, your concern about good times is reduced because you don't get particularly satiated. So whether it's good times or bad times, it doesn't matter that much to your extra happiness. So you're willing to take a lot of extra risk because you're not going to be, that 20th cupcake feels as good as the first cupcake. But if you're very risk averse, you have a high risk aversion, then the last cupcake, the 20th, doesn't help you much, but you're really concerned about having very few cupcakes because that first cupcake tastes great. It's really important to you. So you don't want to end up in a situation where you don't have any cupcakes. So you're very concerned. And so risk aversion, surprisingly, is really directly connected to satiation. We probably should have used that word satiation rather than risk aversion to describe that key feature of our decision making. Now, we are all risk averse. There's all of us want to save for retirement, and that's because we don't want to splurge today and starve tomorrow, or starve today and splurge tomorrow. We're trying to smooth our living standard. That's because we are risk averse, because we get satiated. We don't want to consume it all today and all the cupcakes at one time. We want to spread them out. And the same thing happens when you think about things, risks that you might experience. For example, your house could burn down. Well, you don't want to go into that situation and be uninsured. You don't want to not have any homeowners insurance, and then your house burns down, you have nowhere to live. Because you're risk averse, you don't want to do that. So that would be splurging in the context of your house not burning down, but starving when your house burns down because you've lost a place to live. You wouldn't have the money to rebuild your house or anywhere to live possibly. So consumption smoothing, satiation, risk aversion, this all explains why we buy homeowners insurance and every other kind of insurance, whether it's car insurance or health insurance. Some of us even buy pet insurance. It's all about consumption smoothing. And the same thing applies when we talk about diversification of our investments, of our assets. We don't want to be living high on the hog when the stock market soars because we've put everything in the stock market. And then if the stock market plunges, which it may do in the near term, is my concern and belief, then we will be starving. So this is why we want to not put all our eggs in one basket. We want to diversify, spread out our investments across different types of assets, not just stocks, so that yes, if the stock market soars, we won't get to consume as many cupcakes, but if it crashes, we'll still have some cupcakes to consume. So I hope I haven't belabored that cupcake analogy too much, but some of you are probably running off to get some cupcakes right now. Anyway, this is just a picture of the standard life cycle diagram that shows that, gee, your earnings and your income is very variable. There's other things like taxes that are moving around. There's special expenses. You've got college tuition for your kids. You've got a mortgage to pay off. That earnings curve is that green one is kind of proxying for all the variability in your income and your negative income streams that are hitting you. But what you're trying to do is have a smooth living standard. That's consumption smoothing. And that's what MaxiFi is set up to do, to deliver a smooth, what we call living standard. Now, when it comes to thinking about insurance and diversification, then we're talking about smoothing across good and bad times. Good times is when we're healthy, when we have income, when we have a house, when our stocks are booming. Bad times are when are times when we're sick, when we're poor, when our house burns down, when our stocks crash. So we want to move resources from the good times to the bad times. We do that by buying insurance, and we do that by diversifying our portfolios. Just like we move resources from when we're young and working to when we're old and not working, when we're retired. So we take these actions to make sure we have something to spend in all these situations, when we're old, when we're retired, when we've had some bad luck, and when we have seen the markets crash. So what about living standard? How does this connect to consumption? So the theory is about consumption, but consumption in the real world really refers to your discretionary spending, because you have some fixed expenses like taxes, housing, alimony, maybe tuition for children, which you just have to maybe your loan repayments, car loan repayments, for example. You have to make those expenses. You have to pay those things. So that's not really what we call, in terms of MaxiFi, your consumption. What we call your consumption is everything left over, your discretionary spending, and we look at that per household member. If you're a household with 5 kids, and then the kids are gradually going to be leaving the household, what we're really interested in doing is smoothing the living standard per household member. But the software takes into account the fact that there's economies in shared living, and that the kids cost a little bit less than adults. So we're trying to take those factors into account. But the key idea here is consumption smoothing refers to trying to maintain discretionary spending per household member. Now, living standard risk refers to the variability of your living standard. That's what you're concerned about when it comes to investing. How much living standard risk are you undertaking? And that refers to just how much, what are the highs and the lows of your living standard that you might experience per household member. And so the riskier your portfolio is, the larger your living standard risk. So if you earn high returns this year, you're going to raise your spending. So your spending, your living standard will go up. If you do poorly on the market, you're going to lower your living standard. That would be the thing that most people would do. They would adjust their spending in light of how they're doing on the market with their investments. And these up and down swings in your living standard associated with getting high or low returns refers to living standard risk. And we're trying to think about not minimizing that or reducing that risk through diversifying your portfolio. If you just held stocks, you'd be in a much riskier position with respect to your living standard risk. If you just held cash or short-term bonds, you'd have lower living standard risk. Diversifying, again, is going to mean holding some of both, and that's going to reduce the swings in your living standard. So how do you understand how much living standard risk you're going to have? Well, you need to really see it. And when I say see it, I mean see it with your eyes, not hear somebody talking about it, but actually be able to view where your living standard could end up if you invest this way versus where it could end up if you invest a different way. And so this requires generating living standard trajectories. And each trajectory, and I'm going to show you these trajectories using MaxiFi, they correspond to one path that your annual living standard may take. And MaxiFi, when it looks at an investment strategy, and an investment strategy is you're telling the program how you're going to be investing your assets, your retirement account money, your regular assets through time. So when you're young, you might put it, 80% in stock, and then maybe gradually have it switch more towards bonds. Whatever that strategy is through time, that's called your investment strategy. And that strategy is going to dictate how much living standard risk you end up taking on. But you need to see that again. And what we do is we run these trajectories. So we start off at your current age and we say, okay, let's just follow you through time based on you're getting at random returns that are based on what you're holding in terms of your investments. So if you're holding stocks, we take draws from the return on stocks. If you're holding bonds, we take draws from the return on bonds. If you're holding REITs, which are real estate investment trusts, we take draws on that. If you're holding gold, we take draws on that. And we also take into account the fact that these returns on these assets are correlated historically. So we're using historical data as far back as we can and taking into account the covariation of the returns on these securities. So if stocks do pretty well this year, well, then there's a higher chance that bonds will do well. So it's not like we're treating these returns as independent. That's not, that wouldn't be reasonable given that they actually are correlated. So we take an independent draw on stocks, and then we figure out what that implies for kind of where the bond returns would likely lie, take a draw on the bonds, then use that information to take a draw on the real estate. Depending on what you're holding, we're taking draws on all the securities you're holding and getting your total overall portfolio return. And then we're using that to figure out how your assets are going to evolve and also how your spending is going to evolve in light of how your assets are evolving. So the annual returns determine your annual ups and downs in your living standard. And our software is very different from conventional planning, which assumes no adjustment whatsoever to market returns. So just to be clear, if you're sitting here in 1929 and you were holding stocks and you held on to those stocks through 1933, the stock market fell between those two dates by 86%. Conventional financial planning assumes that you'll never make any adjustment whatsoever, even though your wealth is going down the tubes. But that doesn't make any real economic sense, and it's certainly not what economics predicts people would do, nor is it what people actually do when we look at what they do. And our software assumes that people make adjustments every year based on how well they do on the market. And that's why we get this variability over time in the household's living standard, and that's a trajectory. And then MaxiFi is running 500 of these trajectories. So if you're dealing with a 30-year-old whose maximum age of life is 100, we run one trajectory is just looking at all the different, the whole path of living standard between 30 and 70. And then we go back and start the person back again at age 30 and produce another trajectory. And then we produce a third trajectory and then a fourth. We produce 500 trajectories, and then we show you what these trajectories look like. We summarize them in terms of high and middle and low and intermediate trajectories, which I'll show you momentarily. And then we also do something, as I mentioned earlier on, which is that we analyze, we've got 500 trajectories, and you've got somebody living from 30 to 100 possibly. That's 70 years times 500. That's like 3,500 living standard outcomes. How do you look at all those numbers and figure out what to do? It's complicated. So what we do is we take all those numbers and we condense them into one measure, which is this expected happiness, lifetime happiness measure, which I refer to as expected utility, and I'll get to that. So here's two trajectories that MaxiFi, these are trajectories coming right out of MaxiFi for a particular household that I'll tell you about in a moment. You can see that the orange one is a good trajectory. The individual did well along that path, and the blue one is a low trajectory, didn't do as well. And you can see that even if you do well on average, you don't do well every year, and that's what's called sequence of return risk. You could do well in the beginning. Look at this top orange trajectory. The individual is doing well for a while, and then they start getting low returns, and they have to adjust their spending down. That's why their living standard, which is being charted on the axis, the vertical axis here is the per adult living standard of the household, and then the horizontal axis is just the year. And what you see is through time, the living standard is basically heading north, but it's got a long period where it declines because there's a number of years there where the returns are poor. And in the blue trajectory, where on average the returns aren't so great, there are still some years where the returns are pretty good. And these curves can actually cross. There's nothing that says that they can't cross, even though one's going to be on average higher than the other across all the years. Now here's the case study that is producing those two trajectories. And just to be clear, we make 500 of these. You're seeing 2 of these, but under the hood of the program, when you run the risk analysis, we make 500 of these for your base investment strategy. And then we also ask you to tell us about 2 other strategies, a safe strategy and a risky strategy. And I'm going to show you the program and just point out this in a different way by showing you exactly the program. But we ask you to tell us about 2 other investment strategies. So we make 500 trajectories for your base strategy, and then we make 500 trajectories for your risky strategy and 500 for your safe strategy. And then we compare the 3 different investment strategies, as I'll show you. So it takes a little bit while, when you're sitting there waiting for MaxiFi to chug along, realize that it's doing lots and lots of work. It's using parallel processing on Amazon web servers in some part of the ether out there, whether it's in Texas or California. I'm not sure where in the cloud the servers are located on a given day or point in time, but there are these trajectories being run simultaneously, 500 for each of the 3 investment strategies. And we'll be talking about this couple, Martha and Sam. Martha's 54, Sam's 55, Massachusetts couple. She's earning $200,000. Sam's earning $50,000. Both are going to retire at 62. They have $1 million in retirement accounts. They have $400,000 in regular assets. They have $1 million house with a $500,000 mortgage. And they want to compare 3 very simple strategies. So, and these are not changing through time, although I could have considered strategies that change through time, but the 50-50 is the base strategy, and that's just holding 50% stocks and 50% bonds. The 20-80 is 20%, that's a safe strategy, it's 20% bonds and 80% stock. The 80-20 is the 20% stock, 80% bonds, that's the safe strategy. 80% stock, 20% bonds, that's the risky strategy. So we call these the base, the safe, and the risky strategies. And we've run, right now, I'm looking with you at the base strategy, which is the 50-50 strategy for Martha and Sam. And what you're seeing here in the green curve is the 95th percentile. And what that means is that if you look at the across all the years from their mid-50s right to age 100, they could make it to 100. That's their maximum age of life. If we take the average of their living standard, well, this green curve has the 95th highest average level across all the years, across all 500 trajectories. And the blue curve has the 75th highest. And the purple curve, it's the 50th percentile. It's the 50th highest. And the yellow is the 25th highest. And the red is the 5th highest. And that's called the 5th percentile. That's just, you know, the lingo percentile, but you can also just say 5th highest. That's easier to absorb, I think. Anyway, so we're not showing you all 500 of these trajectories right here because that would be a little bit overkill, but we are summarizing, and you can see that there's upside risk. The green curve is a great outcome, but there's also downside risk. You could be on the red trajectory, and how you invest, how aggressively you invest, determines the spread of these curves, of these, you know, how this kind of cone of outcomes, of living standard outcomes, how much it spreads out through time. That's determined by two things. One is your the riskiness of your portfolio, how aggressively you're investing, and also how aggressively you're spending through time. And I'll talk to you about that more in a sec. So here's a comparison of, and I've taken all these charts right from the program. So here's looking at the 3 different investment strategies, but we're just looking at the 5th percentile and the 95th percentile results from each of these 3 sets of 500 trajectories. So if you look at the red curves, the bottom red curve is the risky strategy. It's the 5th percentile, and the top red curve is the 95th percentile outcome. So it's kind of the bad and the good. It's not the absolute worst, but it's pretty bad and it's very good. The base strategy is the blue curves, and that's you know, if you can see the 95th percentile curve there, it's not as high up as the 95th percentile curve for the risky strategy because they're not getting all the upside of the stocks in this case because they're holding less in stocks. They're only holding 50% of their assets in stock through time, whereas in the red strategy, they're holding 80%. In the green strategy, which is the safe strategy, they're holding only 20% of their assets through time in stock. And you can see that the upside is smaller, but also the downside is smaller. The green curve, as you can see it, is above the blue and the red curves in terms of the downside, the 5th percentile. Let's focus in on that downside for a second, because this is something we kind of are quite worried about. And you can see that there is some real downside on the red curve. It's not so much later in life, but we're in the middle of the life. That living standard is probably about 15% lower than it, maybe 15-20% lower than it starts out at. So there is some real living standard risk here associated with investing in the risky strategy, even though this couple, I'm assuming, is spending through time in a very cautious way, because every year when you get your returns, you have to make a spending decision. And we're assuming that this couple through time is spending as if they're going to earn a 0 real return on their portfolio, on their investments. Now, that's the prevailing real return on inflation index bonds right now. It's actually 0 or slightly negative, depending on what day you look. But their portfolio in all the cases has a positive expected return, but they don't want to necessarily count on that. So they spend in this cautious manner through time. And consequently, they don't have a whole lot of downside. I mean, it's not a terrible downside, but in terms of the 5th percentile, but there is a downside even in that context if they're spending very cautiously. So how do we actually make these living standard trajectories? Well, we calculate, let's think about Mary and Sam. I think they were 54 and 55. And right now we know where they're at. You know, they give us their information. We figure out what they're going to spend this year under the assumption that they're always going to earn 1% real. So it's kind of like an as if. What if I were to always earn 1%? I don't know what I'm going to earn in the future, but what if I was always going to earn 1%? Well, how much would I spend this year? And we figure that out. We figure out what that living standard per person is, and we write down that number inside the computer. And then we move them to the next year, to 2021. And before we do that, we take a random draw of the returns on the assets that they're holding, taking into account this correlation that I mentioned. And you can have, by the way, different portfolio of retirement account assets. You can be holding different securities in your retirement accounts, and your spouse's retirement accounts can be different from your from the other spouse's retirement accounts, and your regular assets can be allocated in a different way as well. Anyway, here they are at age, you know, a year older. It's 2021. We've taken the random draw. We know how much they spent when they were in 2020. We know what earnings they earned because they told us about that in their inputs. We know what return they're receiving on their assets because we just drew those returns. Now we've got them at age in 2021, and we again figure out what they would spend in 2021 if they were going to spend cautiously, earn as if they're going to earn a zero real return forever. And then we mark down what their living standard is, and then we move them to age to 2022. At this point, they're age 56 and 58 or 57, and then we again have taken random return draws and figure out what they're going to spend, again under this very conservative assumption. And in this process, we are producing a trajectory of their living standard. And once we've got that whole trajectory, again, we go back to when they're back in 2020, and we start the whole process all over again. And we do this 500 times. And we're doing this all at the same time because we're running this on 500, roughly speaking, 500 different Amazon processors. They're called alpha instances simultaneously, so it doesn't take forever to run. We're not running them serially. We're running these things at the same time and then collecting the results. So now here I want to talk to you just briefly about the issue of aggressive spending. The green curve refers to what would happen in terms of the 5th percentile curve and the 95th percentile curve if Martha and Sam were to spend aggressively through time. So if they spend aggressively, they're going to spend higher in the beginning. You can see the initial spending is higher, and that's going to mean that they're going to have less upside risk because they're going to have spent up more of their assets earlier on, because they're spending, you know, as if they're going to earn 3% real. That's the assumption here, rather than 0% real. And they have less upside, but also more downside. So they get to consume more early on, but it causes this cone of outcomes to tilt. So the spread of the cones is being determined by the degree of diversification. The tilt of these curves is being determined by how aggressively you spend. And in the program, you get to set both things, as I'll show you. Now, here's just focusing on the bottom two curves for from this diagram. I'm just trying to bring them into relief. And you can see that if you spend aggressively later in life, there's more downside risk in terms of your living standard could be substantially lower than it started out. If you spend cautiously, that's the blue curve, even in the 5th percentile outcome, you're not facing at the end of your days. I mean, well, this is not the worst case scenario. It's not the first percentile. It's not the very worst. It's not the minimum outcome. It's the fifth kind of worst outcome. But it shows you that you're going to be doing certainly better at the end of your days, even in bad times, in terms of bad return times, than if you are investing, than if you are spending really aggressively through time. So here's a slide, and you guys are going to get all these slides. I just wanted to kind of mark down the simple mathematics of how we do expected utility maximization. And utility, if you looked on the first bullet here, it's just saying that how happy you are depends on your consumption, your living standard per person. That's what the C stands for. And then there's this kind of funny looking Greek symbol called gamma, and that's what economists call the degree of risk aversion, but physiologists would call it satiation, the degree of satiation. And that's affecting kind of how much happier you get if you've already consumed 19 cupcakes and you have the 20th, or you've had just one cupcake and you have the second. That's what the gamma is helping determine the additional happiness from that. And then, so for each year, for each period T, year T, you're going to have a certain amount of happiness. So on any trajectory, if we're dealing with Martha and Sam, they've got 80, well, they've got about, let's see, from 50 to 100, they've got about 50, not 80. They've got about 50 or so, 50, 45 or so values of this CT, and therefore 45 or so values of the UT. And we, along any trajectory, we add up all the lifetime U's to figure out their total lifetime realized happiness. How much did they end up getting along that trajectory in terms of lifetime happiness? And then we're doing this for 500 trajectories, so we average these lifetime values of the sums of the U's across all of the different years, and that gives us an average, and what economists call an average and expectation. That's the statistical term. So we end up with what's called an expected lifetime utility number for this particular investment strategy and spending strategy. It's producing an average lifetime level of happiness. And we then do that we make that lifetime happiness number, that average lifetime happiness number, for not just the base strategy, but for the safe strategy and the risky strategy. And right here you see that we do this for different values of gamma. This is a very small value of gamma, and this is a very big value of gamma. And so we ask, how much risk can you tolerate? If you say you can tolerate a lot, well, we use a small value of gamma, around 1. And then if you say you can tolerate very little, then we use a value of gamma around 9. And if you think about it, let's think about somebody who, let's say Martha and Sam say that they can't tolerate much risk, almost none. Well, the base strategy, we always said we index its level of happiness, average lifetime happiness at 100. So we're kind of just comparing the base strategy with these other strategies. The safe strategy looks better, right? It's got the check mark. It's better than the base strategy by 2%. And we measure that in terms of, it's like saying, gee, if I were stuck with the base strategy, I really want the safe strategy, but if I were stuck with the base strategy, you'd have to give me 2% more consumption or higher living standard in all circumstances to have the same average level of happiness that I would have if I were able to invest in the safe strategy. So it's what economists call a consumption equivalent measure. And then look at the risky strategy. Well, that's like 8% worse, because this person is not, or this couple is not very risk tolerant in this context if they say they can't tolerate much risk. So the risky strategy is just not making them very happy. It's on average, it's going to make them worse off than if they were to do the base strategy and certainly the safe strategy. Now let's go way over here. You can see that the risky strategy, if somebody can tolerate a lot of risk, looks a lot better. So it's 9% better than the base strategy. It's like being stuck with the base strategy, but getting to spend, given you're in the base strategy, with the base strategy, and every outcome and every circumstance, somebody hands you an extra 9% of consumption, increase your consumption by 9%. Well, that's what it's like being able to hold the risky strategy. And then you see that the safe strategy is not so good at all because you're taking too little risk relative to what you'd like. So this is a way for you help to take all the 3,500 or so living standard outcomes that are occurring for each strategy over the 500 trajectories times the 50 or 45 or so years, or maybe it's more like 4,500 outcomes now that I think about it. And, you know, putting them all together into one number that you can then compare and say, well, do I want to hold a 50-50 portfolio if I'm, let's say, moderately risk averse, or do I want to hold a 80-20? Well, I actually want to hold a, you know, do the base strategy. It beats the risky strategy. So this is a way for you to use MaxiFi to help guide you in deciding what portfolio to hold. And this is really the gold standard in economics. Economics has been after a way to calculate this. It's not like we couldn't calculate this in terms of our models, but to do it in a really focused way, take into account all the taxes and Medicare Part B premiums and the presence of kids and economies of shared living, all these factors that we've spent 27 years in our company to, you know, incorporating in our program, all those Social Security provisions and rules. That's something that doesn't exist anywhere except in this program. So let me now go to the program itself and just show you Sam and Martha. So here they are, and they have, I'm just going to blow this up. So as you know, as I mentioned, Martha's got $200,000 in earnings and Social Security earnings record, and so I've entered all these inputs and retirement accounts, and we've got some information for Sam, and then there's information about the household. They have this house with a mortgage, and they have the $400,000 in regular assets. So I've run in prior webinars this report, and I've run this report, the maximization report, and I've also shown you how to manually try and find safe ways to raise your living standard. And by the way, all the webinars are posted on our website. The ones we've Alex is going to send you a link to this particular webinar, but if you go to MaxiFi.com and you click under, you know, at the top it says for households or for planners, and you just look at the menu underneath those headers, you'll see webinars, and just click on that and then scroll down. You'll see videos of all the webinars that we have done so far, and we're going to continue to do webinars. The next webinar we'll be sending you an announcement about. It's going to be done by Rick Miller, who has he's actually a financial planner, who's advisor, who's been using our software in his company for years, and he's also an economist, and he'll be talking about decisions around retirement. When can I actually retire? And showing you how he uses MaxiFi to look at that issue with his clients. So anyway, the risk analysis starts here by clicking on that, and we have a set of things that you can do. First of all, you can set up particular assets that you want to incorporate in investment strategies. So you can make set up assets. You can kind of create your own assets if you want. Enter the assets, the asset return histories, or you can use our canned assets. We have dimensional funds. We also have canned assets in here. So there are lots of assets that are already entered that you can use, but if you have special assets with a return history, you can enter that as well. And then you can set up investment strategies here, and you just come down here and create your own strategy or use one of the ones that we've set up for you. And then you then will set up the base strategy, the safe strategy, and the risky strategy. And you can always look at the details. This is 50-50 stocks, bonds every year, and it can be time varying if you want, but it's actually quite simple to use. And we have a video tutorial that helps you understand how to use the interface here. Then if I hit continue, here we're asking how aggressively do you want to spend? Do you want to spend as if you're going to earn 1.5% real return, sorry, nominal return. The inflation rate that they're assuming is 1.5%, which is what the market is saying we're going to be getting over the next 30 years. So here I'm assuming that they're going to earn a 0 real return, and that that they're going to act as spend as if they're going to earn a 0 real return. And I'm just going to now run the program, and you'll see the production of these trajectories. It's now going to take probably 2 minutes because, well, maybe it'll go faster, but it's doing lots of calculations. And so what we're going to see initially are results for the base strategy, and we'll see the first trajectory, another trajectory that's not quite as good. Then we're going to see these very high, pretty high, medium, pretty low percentile trajectories. And then the program summarizes kind of where these trajectories end up, all 500 trajectories. It kind of shows you a different way of looking at where they end up falling in that kind of cone of outcomes. And then it shows you a picture of looking at all basically 4,500 outcomes for the base case. And then after you've kind of looked at that, we go and look at the other two investment strategies, and we compare them on the expected utility basis, but also we compare the actual cones for each case. So here you see one trajectory that, as I showed you before, here's another one. You can see that because of sequence of return risk, even though the orange curve does a whole lot better on average across all the years, the blue curve sometimes just, at least in one case, because the returns are high for a while early on, it actually crosses the orange curve. If I hit next again, I see this cone of outcomes that I've told you about. And now this is just a different way to summarize all these outcomes that I was mentioning. I'm not going to get into the details. I want to get to your questions too. Here's yet another way. You can read all about these. It's pretty straightforward. We also have these tutorial videos and some case studies under case studies, which are on the home page. If you click at the very bottom, it says case studies. Anyway, here's the chart I just showed you showing up in MaxiFi, and you can see that if the couple is pretty risk tolerant, they want to go for the risky strategy. If they're risk averse, they want to go for the safe strategy over the base strategy and the risky strategy. And then we have some comparisons of the. So here we're looking at this chart I showed you before, which is the pretty, quite good and quite bad outcomes for the risky strategy, for investment strategy, for the safe strategy, and for the base strategy. And here again, we're focusing on the downside. So, and then we have some statistics for those who are into those kinds of numbers. But the main thing I want to point out is that these pictures help you really to see where where the upside is, where the downside is. It worth it to be investing at risk? Do you want to experience the possibility that your living standard is 33,936. If you invested 80% in stock when it started out at 38,000, would you want it to go down to 34,000? You know, that's about a 10% cut. And if you were spending more aggressively, this red curve would be further down. It might go down from, you know, 40, some number might start around 45,000 and end up around 35,000 or 33,000. So by playing with these different things, how you're investing, the diversification, but also how aggressively you're spending, you're going to see where you're going to be ending up, the range of where you're going to be ending up, and get you thinking about how you do want to invest and also how aggressively you want to spend. And this expected lifetime happiness measure, which is the standard, using the standard measurement of happiness that economists use, can help guide you. So let me stop there, Alex, and ask you to hit me with some questions, okay?